Welcome back to The Explainer. Today, we are jumping straight into a totally head-scratching financial paradox that's playing out right now in the stock market with Terawulf, trading under the ticker WLFF. Normally, financial metrics tell a pretty logical story. But Wolf's numbers? They're shouting two completely contradictory things at the exact same time. It is literally a masterclass in extreme market valuation.
557.72%. Just let that sink in for a second. That is Terawulf's trailing 12 months return. If you had invested a year ago, your money would have multiplied more than 5 times over, with the stock recently trading around $21.31. It's exactly the kind of breathtaking, high-octane growth that gets the entire market buzzing.
But here's the catch, and it's a massive one. While the stock price has been absolutely soaring, the underlying company is losing a monumental amount of money. We're talking a trailing 12-month net income of negative $661.4 million, over $500 million in the red. So this is the ultimate paradox: triple-digit stock returns that are entirely disconnected from bottom-line profitability.
Okay, let's dive into this mystery step by step. First, we'll cover the unbelievable stock returns, then explosive revenue versus deep losses, valuing a financial anomaly, and finally, debt, cash flow, and risk. Part 1. The unbelievable stock returns. Right now, Terawulf's market capitalization sits at a staggering $10.58 billion. Think about that. The market is essentially declaring that a business operating at a $660 million net loss is somehow worth nearly $11 billion. How on earth can a company burning through this much capital hold such an astronomical valuation? And this brilliantly illustrates the reality of the situation. Look at the year-by-year breakdown. In 2022, the stock suffered a near wipeout, plunging over 95%. But then, whiplash. A 260% gain in 2023, followed by a 135% gain in 2024. Investors here definitely aren't looking for slow and steady. They're riding massive, volatile waves of market sentiment. Part 2. Explosive revenue versus deep losses. So, to actually understand this paradox, we have to look at the growth engine. Terawulf is growing its top-line revenue at a blistering compound annual growth rate of over 123%. It's explosive. But contrasting that is an abysmal net profit margin of negative 193%. Basically, for every dollar they bring in, they lose nearly $2. The market is rewarding that explosive top line and completely ignoring the bottom line bleed.
When we pop the hood and break down the core business model, the gross profit margin is actually quite healthy at 49%. The direct cost of creating their service leaves them with almost half their revenue intact. But once you factor in operating expenses, interest, and administrative costs, that gross profit is entirely wiped out, dragging the business all the way down to that staggering negative 193% net margin. The core engine works, but the corporate machine is just devouring the cash.
Part 3. Valuing a financial anomaly. Since Terawulf's earnings are so deep in the negative, we can't really use traditional Wall Street metrics like a price-to-earnings ratio. Instead, investors turn to the price-to-sales, or PS ratio. Let's do a quick educational breather. This metric just compares the total stock value directly to the revenue generated. It strips away all operating expenses and essentially asks, how much are investors paying just for the sales? So the crucial point is that Terawulf's current price-to-sales ratio is 62.81. To put that into perspective, a mature, stable company might trade at a PS ratio of 1 or 2. A hyper-growth tech darling might trade at 10 or 15. But at nearly 63, investors are willing to pay almost $63 today for every single dollar of sales Terawulf makes. The market is pricing in absolute perfection and massive, sustained future growth. And the sky-high multiples don't stop there. The enterprise value-to-sales ratio is nearly 71. The price-to-book ratio, which compares the stock price to actual net assets, is nearly 64. And the return on equity? A dizzying negative 470%. These metrics reinforce that this stock is floating entirely on the promise of tomorrow, completely detached from traditional asset realities today.
Part 4. Debt, cash flow, and risk.
To truly grasp the risk involved here, we have to look at the debt-to-equity ratio. This measures a company's financial leverage by dividing total liabilities by shareholders' equity. Generally speaking, the higher this number, the higher the risk, because it means the company is heavily reliant on borrowed money just to keep the lights on.
For Terawulf,
That debt-to-equity ratio is 36.82. That is literally staggeringly high. And what's even more concerning is that this ratio is up 277% from its trailing 12-month average. So they aren't just highly leveraged, they are taking on debt at an accelerating pace to sustain all that explosive revenue growth we talked about.
And here is the ultimate reality check, negative $1.18 billion. That is Terawulf's trailing 12-month free cash flow. Now, net income can sometimes be skewed by accounting rules, but free cash flow, that is the hard, cold cash moving in and out of the business. Burning over $1 billion in cash in just 12 months is the ultimate risk factor. Despite that $10 billion market cap, the company is bleeding cash at a historic rate.
Which brings us to the final, provocative question. Is WULF a high-growth miracle, successfully capturing market share at any cost on its way to total future dominance? Or is it a debt-fueled bubble, where a $10 billion valuation is simply masking an unsustainable cash burn? The 550% returns are absolutely real, but so is the massive debt. The data's on the table, so it's up to you to decide how this paradox ends. Thanks for joining me on this explainer, and we will see you next time.